Namaste, welcome to Arthaniti, where we discuss money and money matters to help you in your investing decisions. The markets are in a free fall. What is happening is unfathomable. We are seeing our wealth evaporate in front of our eyes. In the last five trading sessions, 18 lakh crore rupees worth of investor wealth has vanished into thin air. That is more than the GDP of 122 countries. While most of us are panicking, some smart, shrewd investors are positioning themselves not just to protect them, but to thrive in this market bloodbath. In this video, we will look at the factors that is causing the markets to fall and also look at some actionable steps that we as investors can take so that we can sail through these stormy times and multiply our wealth in years to come. If you are a stock market investor or are planning to invest in the stock market, this is a must watch video for you. So let's begin. Picture this. It is September 2024 and the Indian stock markets are flying high like a kite soaring in the sky. The Sensex hit an all time high of 85,000. But the winds suddenly change. Come February 2025, the market has tumbled down to 75,000 mark, an 11% decrease in the past 5 months. Investors are left scratching their heads. What is happening? Is this a phenomena only in the Indian stock market, or are markets all over the world falling? Well, let us see. In the last 1 week, Sensex has fallen by 2.5%. Nifty is below 22,850 levels. While on the other hand, the US markets, S&P 500 is up 1.5%. Nasdaq has gained 2.6%. Hong Kong Hang Seng has gained 3.7% in the same period. Many European markets are also in the positive. So, what exactly is the problem with Indian stock market? Why is the market crashing? Who is the villain of this story? Well, there is not one but four villains causing this market mayhem. Firstly, the growth slowdown. Nifty 50 companies have recorded an earnings growth of on an average of 6.5% for quarter 3 for financial year 2025. Compare this with the expectations of 11 to 12% growth. So, way below expectations. Secondly, the rupee is on a roller coaster ride. The currency has weakened from 82 to a dollar to 87 to a dollar and recovering back to 86.50 levels. This has happened in the past 6 months. The US tariff threat is looming, with Trump flexing his muscle with a potential 25% tariff on key Indian exports. And lastly, the FII exit. FII, foreign institutional investors, have pulled out nearly $8.5 billion since September 2024. So, all these four factors are causing this market turbulence. One more reason is the valuation bubble. Many small cap and mid cap stocks have reached not only their 52-week low but nearly 114-week low, and yet they are overvalued. The total market cap to GDP ratio stands at a whooping 114%, which shows that the market is still overvalued. Many people are saying that this market crash is different. Now, that is true to some extent. This market crash is more focused on fall in the small and mid cap segment, while the large cap index is relatively stable. The small cap index has fallen by nearly 16% in 2025. Mid cap has fallen by 18%, while the large cap Sensex has fallen only by 3%. Now, if you compare this to the 2008 and 20 market crashes, the crash was all over. It was not sector specific or segment specific, but the whole market had crashed. So, yes, in that context, this crash is a little different from previous crashes. We have seen the villains, but every story also has heroes which save us from those villains. In our case, it is the RBI who has wielded a sword of monetary policy by cutting interest rates by 25 basis points to 6.25%. The government, on its part, has introduced tax cuts up to 12 lakh rupees worth of income. Our companies are innovating and adapting to fast growing technological changes. The IT sector has still shown a 10% growth in all this turbulence. And lastly, we as investors who need to be patient, wise, and ready to seize opportunities. So, yes, all these factors can help us ride through this current wave of turbulence. So, what's next in this market saga? Well, here, viewers, you and me become part of the story. Remember, the market is down but not out. Firstly, every dip is a buying potential, is a buying opportunity. The Sensex rebounded 30% after the 2008 fall. Secondly, diversification is the key to weather out any storm. Inclusion of large caps, mid caps, and small caps in the portfolio will help balance risk. And thirdly, long term perspective is the key. Remember, in the past 20 years, Sensex has given a CAGR return of 13%. So, the longer your time frame, the better you are shielded against short term volatility. Now, the million dollar question: is it time to invest in the market or wait and watch? Well, here is something to ponder on. The best time to plant a tree was 20 years ago. The second best time is now. Remember, in the stock market, it is not about timing the market but time in the market. The Sensex has grown from 1000 in 1990 to over 68,000 today, rewarding who? Patient investors. So there is never a good time, but always the right time to be in the market. So, what should be the strategy of smart investors? Well, here are some actionable steps that we can take. Firstly, consider sector rotation. Not all sectors perform well all the time. Given the background of increased income in the hands of individuals, why? Because the income tax limit was raised to 12 lakhs, the interest rate cuts by RBI, all these will have a positive impact on the consumer discretionary sector. So focus your attention to companies in auto sector or jewelry segments, FMCG, consumer durables. Also look at renewable energy. Why? Because of substantial mention about it in the budget. Look for quality stocks. Some FMCG companies like ITC, Nestle, HUL, companies in renewable energy sector like NTPC Green, Adani Green. These are just names that I'm giving you. These are not recommendations. Secondly, adhere to risk management. As I've already said before, diversification is the key. Include multiple asset classes with bonds and fixed income securities also part of your portfolio. Gold, yes, is a hedge against volatility. Thirdly, hunt for opportunities. Focus on quality stocks. Now, how do you search quality stocks? Here are some quick tips. Look for high return on capital employed, which is at least more than 15%. Return on equity, also more than 15% consistently over the past 3 years. Low debt to equity ratio, lower than zero point 0.7. Strong free cash flow generation. So the cash flow to EBITDA ratio, look for more than 60%. Consistent sales growth with a CAGR of say more than 12% over the past 3 years. Look for a stable increasing operating margins in the company. On the valuation matrix, look for PE ratio which is below the industry average or below 40. Price to book ratio below 1.5. Some additional parameters to check: check the promoter holdings. Has it increased or decreased in the near past? low promoter pledge, at least less than 5%, a clean auditor's report, regular dividend payouts, and a stable growth in earnings per share. Now, these are some of the matrices which you can use to search for quality stocks. So, what should we as investors do? Firstly, don't panic. Remember, market corrections are normal and they present a buying opportunity. Secondly, diversification is the key to ride through volatility. Third, focus on quality. Fundamentally, strong companies will help multiply your wealth over a long period of time. Fourth, consider fixed income investments in your portfolio to give stability that it needs. Always have a long term perspective. Quality stocks tend to create generational wealth. The Nifty Quality 30 index has outperformed the Nifty 50 since its inception. Also, the Nifty 50 has given a return of, on an average, 13.5% in the last 20 years. And stay informed, listen to my channel, and get all the information that you need to take right investing decisions. That is all for today. If you have liked this video and if you think it has added value and helped you calm your nerves, please like, share, and subscribe to my channel for more such informative content. Until next time, happy investing.